Hey, I'm Dana Segundo. For my previous video that you guys were watching, a lot of you guys, I really appreciate your support and all the subscribers. For my previous video, I was talking about both short-term and long-term holdings in your stock portfolio. So now, I promised you guys that I was going to go into in-depth analysis of the companies that I said to buy and companies that were going to be affected by the pullback. And so now I'll go into that. Okay, so let's start off. The market pullback, it did get delayed a little bit, and I'd probably blame it on optimism. And I mean, I'd just say it tanked. S&P was down to 1,300 before we could say what the heck happened. And I'm gonna blame it, on a crappy jobs report. A lot of people were expecting a lot more jobs than were created in April. And now it's kind of been keeping up with this pace and not kind of building back 1,400, just due to how the euro and Europe has been acting. And let's just hope Greece doesn't leave the euro because things will become a disaster. So when it comes to these companies, not all of them reached what we wanted them to reach, but some of them did, and some new opportunities came up. Okay, so there's still some from my last video that did. One of those was NOV. It's a big oil drilling company, market cap around $30 billion. So it isn't as big as Schlumberger, around a $90 billion market cap. So personally for me, I prefer NOV just because I think it's more efficient, and also because it seems to, a smaller a company is, even though it's still $30 billion large market cap, it can cover more ground. As growing 10%, it only has to jump $3 billion, as opposed to Schlumberger has to grow 9. So that's definitely a plus. So for NOV, here I'll pull up a chart. For NOV, and I'm also going to add, in short term, we're always talking about margin of safety, and with NOV, right now, you have a huge margin of safety. So I bought this company for paper trading, and it was around $86, and you have to compare this company with price of oil, WTI crude, not Brent, when it's at whatever price a barrel. So when it was around $85, 86 bucks, oil was around $110 a barrel. So obviously, because NOV is completely impacted by supply and demand of oil, when oil levels are low, it's obviously a great time to buy, which is what's happening now. So that's why I would really advise you guys to look into even considering this company. Right now it was around 86, and it's just oil dropped down to like 90 bucks a barrel. It was even at 89 for a second, and now it dropped down to 63. It rallied a little bit back up to 68. Now the great thing about NOV is that it definitely, even though it goes down a little bit more when the market is dropping, it tends to plunge upwards a little bit, and more, great market momentum. And so, I'm not going to sit here and calculate the beta or anything, but it definitely seems to be a good company with market momentum in oil. So with NOV, even right now, you have a pretty big margin of safety of around, that's $23, so around 35% margin of safety, which is great. And since we're considering that it is a short-term hold for around 2 to 3 months, it really all depends what you want to hold and hold on to it for. But I definitely would consider it a short-term hold, though, because oil obviously is volatile, and it, unless we get into a war with Iran or something, oil's gonna stay between its constant $90 and $110 a barrel. So yeah, it's definitely great. I would not mind letting it drop a little bit more to like 65, just to further increase the margin of safety, though. Okay, so next on the list, and this is a new one that we added, is Caterpillar. So it's a great large retailer of infrastructure and designing infrastructure, and sells heavy machinery. So with Caterpillar, back and like I said, we're comparing everything to where the market was. With Caterpillar, it was back at $116 back when S&P was around 1,400. Now S&P is around 1,300, and it's trading around $90 a share. So you have around $26 difference, and it fairly nice profit margin. And it's pretty much as low as it's gonna get. I don't see this Euro stuff affecting us for much more because you have to understand they're two different markets, despite there's ripple effects. But it's a strong company, great company, and definitely has a pretty wide durable competitive advantage. Another one that we're looking at is Deere, which is pretty similar except it is more agricultural. So Deere, you can tell from the graphic, it's up and down a fair bit, but this is a little bit on a smaller scale. So Deere, when the market was a little higher, around $85 a share, dropped down to around 70, 72, which gave you a great entry point. And it's still 75. It's still giving you a very nice entry point. You don't want to get too greedy. So if you catch the market on a bad day, maybe Deere's down 2 or 3%. Look into it. Yeah, great company. So with CF, agricultural holding company as well, and a lot of these companies are cyclical. I mean, so their PE ratios and valuations tend to be more on the lower side, which can be a pretty good thing because people expect less out of the company. So I mean, it really, as opposed to, that's why I honestly prefer something like this over Lululemon. They're different companies and different sectors, but with this, as opposed, when it's trading at 8 times earnings, it can't get hurt as much as a company like Lululemon trading at 55 times earnings. So people expect less out of it, and it definitely can help. That helps the whole shock factor. So CF, peak of the height of the market was around $202. A month or two ago. It was like a month, and we had a little pullback, and it plunged a fair bit, around a solid 30%, 20% to 154. And that gave you a great entry point. So that I bought there for paper trading around 156. Now it's back at 166. I don't feel as good about it as I would buying at 154 because you have a big profit margin from there, and great margin of safety, like a little net. But around 160, I'd consider it. Anything past 155, I'd be a pretty big buyer in CF. I like what I'm seeing from that. And so in the other video, we also talked about companies like Apple. The problem with Apple right now is that it's too volatile. Nasdaq's moving up and down, and Apple's the pretty big cause of that. And so Apple, it got down all the way to 520, 522, and that I wish I had seen it, but I honestly thought that it was gonna get to around 500, maybe even 490. But yeah, it's been kind of up and down motion, and it had a great day on Tuesday, I believe. Up 30 points, $30. So kind of crushed any hope of me looking into it, just because I like to have my margin of safety. And lastly, actually not lastly, Starbucks. The company, it's good, but the margin of safety really isn't there, and it just hasn't dropped enough. Once it gets around 50, 48, that's a great point to buy, but other than that, just isn't there yet. And lastly, for short-term analysis, TNA. Now TNA, it's pretty good. The thing is that it's leveraged. So market goes up, or Russell, IWN goes up 1%, TNA is going up 3%. So basically, it's one of those things where you have to make sure that the timing is perfect, because you don't want to be, IWN's down 3% and then you're down 10%. So you have to understand that there is some risk equated with this company, ETF, but there's definitely a good profit margin if you time it right. But it's definitely more on the riskier side. So for any beginning investor, I'd probably vote against it, and I'd probably stick to more equity style company. Okay, so that's pretty much it for short term. Now, when it comes to long term, I've looked at some other more other companies Another one that I like that I'm seeing a lot of is Wells Fargo. Big company, and like I was saying, it isn't going to make you rich. None of these big market cap companies are going to make you rich, but it's a much stabler industry. And so basically you just have to wait till people begin, Wall Street begins to think fairly stupid. Whereas, back in 2008, people are like, Ruby Tuesday is $1 a share, goes up to 10, and because people are afraid of the restaurant industry, and the same thing's happening now with the farm industry. People, yes, there's paddock cliffs, but obviously the drug companies are going to create other drugs, and big drug that's ending right now for Pfizer that has been impacting its multiple recently is Lipitor. So that's pretty much that for pharma. So yeah, short term, you definitely want to establish your positions when the S&P is around 1300. 1320, it's a little bit too high, and we're just trying to make as much as possible. So definitely important. So that's pretty much it, guys. Thank you for all the support, and please feel free to leave any comments or subscribe, and if you just want to hear my analysis or anything, just send me a message, and I'd be happy to make a video and just be able to share my thoughts with you guys. Alright, thank you.